On a recent Insights episode of Fintech Insider, we discussed the collaboration between finance and other departments, and we weren't the only ones talking about it. Plio's latest Finance and Business Synergy report dives deep into these challenges and how businesses can overcome them. With 66% of UK finance leaders saying they would have made better spending decisions if they had greater collaboration, it's clear that breaking down silos is key to success. The report highlights why 79% of UK businesses believe you have to spend money to make money, and how the right digital tools can help make that spending smarter. This report will give you even more insights and strategies to take back to your team. So download the Finance and Business Synergy report today at plio.io/11FS to learn how better collaboration shapes better business.
It's back. The 2025 edition of our annual Pulse report, where we unveil and break down the best user experience financial services has to offer, is out now. Our experts have been busy researching and analysing product experiences from every corner of financial services, from crypto to inclusive design. Find out who were named our Pulse Stars, the best of the best from 2024. Read our highlights from the state of UX in the industry. And discover the bold predictions that our experts have made for the year ahead. Visit 11fs.com/report to download your copy.
Hello and welcome to Fintech Insider Insights. I'm David Brear, CEO at 11FS. And today we are exploring how mergers and acquisitions are reshaping the financial services industry as we know it. For many in our field, M&As feels like the financial world's equivalent of a football transfer season. I wish it was like that. That would be amazing, wouldn't it? Exciting, strategic and game-changing, as we believe. But with increasing complexity from a regulatory frameworks perspective and with tighter margins, fintech-to-bank acquisitions have been slower to take off. Meanwhile, the larger banks are consolidating their power, hoovering up the competition and redrawing the lines of the banking battlefield. So what are the forces driving this massive transformation, and what does it really mean for the future of financial services? To help us answer these questions and many, many more, I am joined by a super duper awesome panel of experts to discuss whether M&As are the solution of our industry's needs or if they might be a bit of a ticking time bomb. First up, and today's panel, we have my 11FS colleague and co-host for the day, Jamie Campbell, who is, among other things, head of VC at 11FS. How's it going, Jamie?
It is going very well, thank you. How are you doing?
Well, having been with you for several meetings today already, I know we're very busy doing various things, aren't we? But we'll foreshadow that and talk about it at a later date, won't we? But very, very good. It's been a busy one. It's nice to see you actually in the office. I feel like we're sort of fleeting, moving stars right now. You're there and I'm not there, and vice versa, right?
Yeah, it has felt like that in the last couple of weeks. But yeah, nice to. I think it's my first recording with you for a while. So yeah, good to be back in the hot seat.
I think they separated us for a reason. Let's see how this goes. All right. Also joining us on the show today, we have a familiar voice to regular listeners. We've got Mariela Hunter, who is a Fractional COO. How's it going, Mariela? It's great to see you again.
I'm super well. I'm really excited to be here and geek out on the resurgence of M&A.
Very cool. And for anybody who doesn't know, what is the life of a fractional COO? I mean, it sounds like you've got lots of stroppy CEOs ringing you asking for things. Is that how it works?
Yeah. So before the fractional CEO, I do have over a decade in M&A experience. That's UK, US, large banks, fintechs. And now as a fractional CEO, I set up a portfolio of companies, Series A to Series C, includes fintech, health tech, SaaS. And with the focus on profit acceleration, I've been doing that in transformation, but also embedding AI in the tech stack, mostly focusing right now on AI agents to accelerate profitability, free up time. And I think the next unicorns are inside people's minds, which is why I'm now also active in the neurotech space.
Very exciting. I feel like there's a whole podcast we can do on that one as well, but we'll come to that when we get there.
I'm in.
Very good. Next up, we have another voice returns in the podcast. Joining us from across the pond in the US, we have Josh Williams, who is the EVP and Chief Banking Officer and Head of Partnerships at Seattle Bank. Josh, mate, you must have some really big cards, don't you, to fit that job title?
Yeah, very small font, David. That's the key.
Yeah, okay. How's things going over there in Seattle Bank? I mean, you guys have been been in the news on and off with exactly the stuff that you guys do with the partnership side for the last couple of years. So busy times, eh?
Yeah, they've been really good. We ended last year just under $1 billion in assets. We're a single location branch or bank, and with less than 100 employees. So the business model has always been about how to have scalable, profitable business lines, and we've had great success in the partner banking side, where we're essentially provided embedded banking solutions to clients nationwide. And then also, I think we've talked a little about in the past. Seattle Bank actually spun out a separate fintech, which is called CD Valet, and that's a new digital deposit marketplace serving the retail CD market, which in the U.S. is over $3 trillion, which is larger than the auto loan, credit card, and student loan markets combined, and a great new opportunity for community and regional financial institutions in particular to compete for deposits and new deposit customers digitally. So we've been busy, and it's great to be here with you guys.
Very good. And I mean, we always say the producers of the Fintech Insider podcast do a great job getting hosts and guests. You guys clearly know your stuff, which is awesome. And last but no means least, and continuing that trend, I should say, Nick, as well, just so you don't think I'm doing you a disservice, we've got Nick Conway, who is Director of Fintech at HSBC Innovation Banking. How's it going, Nick?
I'm really well. Thank you very much for having me on. We're big fans of the show and the team. A lot of fintech nerds over at HSBC Innovation Banking in our fintech vertical. So very excited to be here. Thank you for having me on.
And tell us a little bit more about that role in HSBC Innovation Banking.
Yeah, it's a great question. I sit within our fintech vertical. So we provide banking support to the fintech space, very much focused on that as one of our core verticals for everything from early stage, imagine your first seed check, all the way through the various life stages until you're ready to list or exit via disposal or IPO. And our aim is to provide those banking solutions that you might need to help you innovate, grow, and expand globally. We draw on the deep heritage of SVB in that space. That's who we used to be, SVB UK, when HSBC came in and acquired us. So not only do we have that, understanding of the space with everything from our product partners all the way through to our credit to fin crime people, but now we kind of marry that with the HSBC global platform, which means we can help you grow and expand internationally. And just yesterday, I was on a call with colleagues from the UAE talking about how we could help one of our clients expand into that region. So it's really phenomenal, actually, what we can do. And we love what we do. Our clients certainly keep us busy. Been a really, really strong start to the year. So it's great to get out of the office and spend some time being able to sort of talk, reflect, and think about what the year ahead offers in terms of mergers and acquisitions. So thank you very much for having me on.
No worries at all. And it's it's great to have all you on. And actually, I guess getting into the subject, talking more about the M&A landscape. And really, I mean, financial services and all big financial services organizations are literally a product of M&As over time. It's just, in the scale of the 200 or 300 or more 100 years of organizations, you sort of forget the origin of many of them in terms of where those things have come through. But I guess before we look into 25 and, crystal ball of what's ahead, maybe it'd be important to recap a little bit of those. I mean, Nick, you talked about, obviously, with Silicon Valley Bank and HSBC's heritage, that's one that's very close to your heart. But for the rest of the panel, what have been the impact of mergers and acquisitions, either on the organization that you're in now or one that you've worked with? I mean, Mariela, have there been any that you stand out for you over the years?
Yes, the one that definitely stands out for me has to be a record-breaking deal at the time, an acquisition of only $49 billion, which constituted the biggest banking M&A transaction at the time. And this is, of course, the RBS acquisition of ABN AMRO, doubling the size of the book, the trading book. And as you all know, the history of what happened next with the government bailing out RBS, I think ABN AMRO acquisition should be a mandatory case study of what not to do at M&A. Now, very important to clarify, I was not part of that transaction at the time. In fact, I was busy in the alternative energies business in Shell at the time when this all happened. But then I moved from London to Edinburgh, straight into the M&A team of RBS for the cleanup of the mess of ABN AMRO. And I knew nothing about banking. And here I was, straight into the eye of the storm. 2 years worth of transaction, of course, all sell side, across the globe to sell the various ABN AMRO businesses. And then we evaluated multiple deals after that were more on the traditional side. Fast forward to open banking, things started becoming more interesting. One of the highlights was the evaluation of the acquisition of Monzo. And of course, thank God that the transaction did not go through. And then I moved over to the US, 2 regional banks, and we looked at multiple deals much more strategically. Major focus on payments, including buy now, pay later, wealth, health tech, and a few others. Now, these were more strategic. So M&A was a lever in the broader buy-build partner. And as part of that, we looked at more at partnerships as well, in addition to M&A. More recently, 2022, I've been more on the VC backside. And of course, post the meltdown of valuations in 22, M&A is nowhere in the radar unless it's a necessary and forced exit. But I think looking now at the present, I'm encouraged that banks are now more emboldened with some transactions that have increased the confidence in the M&A. The pipelines are getting filled, and M&A is bouncing back in 2025, showing signs of recovery, demand for AI. We're seeing almost $3 billion in uncommitted capital. With President Trump, there's a return to the White House is expected to relax antitrust and merger guidelines, but it's expected to have an impact on the M&A landscape. We've yet to see how that plays out. A few interesting transactions to call out within the past couple of years are, of course, Capital One's $35.3 billion combination with Discovery, NASDAQ's $10.5 billion, if I'm correct, acquisition of Adenza. We looked at Nationwide, of course, the acquisition of Virgin Money in 2023, Amazon's acquisition of buy now, pay later Axio. So these are just a few, but there's a much more positive outlook for 2025 and beyond.
Okay, and what do you reckon, Jamie? Have you lived through? Because I mean, I'm in a kind of. I feel like this is beginning of a self-help group. But my name's David Brear. I joined HBOS in 2008.
Yeah,
that was interesting. But Jamie, have you sort of lived through any big M&A?
it's funny because my kind of background in financial services and fintech has been from the startup side, and having gone through kind of more traditional fundraisers rather than kind of exits and acquisitions. However, joining 11FS in the role that I have, my exposure to that world has definitely rocketed in a way that I probably couldn't expect or predict. So I think what we've been doing over the last few months here at 11FS is taking more of a strategic look at businesses that maybe we might like to take a look at and bring under the hood of 11FS. And I'll kind of leave it. I guess I'll leave it at that before we get any further into it. So I'm actually really interested because Nick, you got very close to talking kind of in detail about the HSBC SVB transaction, and I think I'm very interested to know, because I certainly can recall what it was like on the outside. Holy shit, it was a crazy few days. What was it like on the inside?
Yeah, it's a great question. So full disclosure, I joined the bank after the acquisition had happened. And I was very conscious during the interview process that some of the people I was working with would be very involved in that transition. So actually my perspective on it is someone who came in afterwards and was able to reflect on the challenges that people faced as a consequence of that weekend and the ongoing kind of integration that happens with HSBC. And actually, my perspective on that helps us when we think about what our clients are doing in terms of acquisitions, because it is so incredibly difficult to do and get that right. If you think about it, you have a big bank buying a little bank with a very core set of clients who are fundamental not only to the economy, but to a broader global ecosystem. And to do that in a very short period of time. And one of the things that struck me when I joined the bank and actually reassured me, like, you're sort of bumbling around trying to be helpful whilst this is all going on and people are just saying, please sit over there and, we'll loop you in when we need you, is just how committed you need your staff to be to the clients and the mission to make something work. So HSBC came in with a tremendous amount of goodwill, a real sensitivity to what they were purchasing, but an understanding of, procedures and policies that needed to be put in place, and a very, very supportive sort of set of employees who wanted to make that happen. They've been amazing. They were amazingly supportive and constructive, so that we were able to get all of that done in, I'd say, less than 6 months. I know you had Rupi on here previously, our head of strategy, to talk about this in more detail. But as someone who wasn't directly involved in it, I actually found it like an incredible experience. I know my colleagues didn't. I mean, they were incredibly challenged by it because you need to engage with your clients every day. So it was very stressful, very demanding. But when you have that mission and focus about really buying into who you are as an institution and what you can bring, then you can get almost anything done if the processes are aligned. And I think we still feel some of that. We're still integrating. It's less than 2 years to go. But it's now that we really feel the power of the HSBC platform and, the opportunities that exist within it. So it's working really well, but I wouldn't say it's easy. It's really hard and it's stressful and it's demanding. And the quality of people you have around you will be absolutely critical to making that work, because you buy a culture.
Yeah.
And you need to find a way of sort of putting your arms around that, protecting it and defending it, because that's, I think, what was unique about the SVB proposition.
Yeah, I think we'll come on to the reasons around why you might get into M&A and, the reasons behind it. But I think it's, probably a good one to call out right at the top, that you can have all the good intentions in the world if you don't have the team and the buy-in and the culture to kind of push it through and make it happen. In this industry, with the complexities that M&A kind of presents, it's just not going to work.
Yeah, it's like that old adage, is there such a thing as a merger? No, it's actually really always an acquisition. However you dress it up, you can only have one CEO, one CFO, one set of one board, and there will be winners and losers in that. I think we're very much protected. We were very much supported in that because we were our own standalone bank, and we retain some elements of that now. We'll see whether the PR people agree with me being able to leave that in. But it's by and large essentially how we've been able to sort of ensure our degree of autonomy within the larger organization.
It's like any relationship, isn't it? It gets to a certain level of seriousness. You've got to decide whose house you're living in, and whose parents you're visiting at the weekend, right? So it's all important things though, and getting those things agreed up front is critical, isn't it? Josh, I mean, how about your experience? Have you lived through any big mergers and acquisitions, or have you witnessed any, or have you done it? Like, what's your experience?
Yeah, I mean, on Seattle Bank, we've certainly been on the growth side. I started my career with then Norwest, which later acquired Wells Fargo. And I think in my first year there, I was in the market research area. And at that time, Norwest acquired a bank a week, to give you an idea of just the scale of acquisition that was happening in the industry. And I was thinking about that.
You can't do that in the UK. Like, if you were a bank a week, you'd only get to like 15 weeks in and you'd be done. But
Exactly.
I mean, it points to how big the banking setup is in the US, though.
Well, and in
Or
fairness,
how
a
sleep
lot of
deprived
those
all
were,
of the bankers are.
Yeah.
yeah. Well, and a lot of that was happening in states where we have, at that time there were probably 12,000 banks. Today there's roughly, less than 5,000. And so, I think right now, where I'd say where we're thinking, or what we've been watching in terms of really M&A on the banking side, is just the lack of it. I think the last 2 years, the total number of deals has been half of what it was pre-COVID on an annual basis. And so what that means is both pent-up supply and demand in the market, but it also means all of the underlying factors that would be driving consolidation, and I think we'd all agree are inevitable, have also been pent up. So there are all the challenges that banks are facing in terms of how to compete for deposits, how to compete for talent, how to think about succession, let alone navigate the tech space. Those issues haven't gone away just because the deal flow has gone down. In fact, they've probably become more pronounced, and now we definitely expect to see the pace and some of the solutions that we really accelerating.
That's so interesting. I mean, we're seeing exactly the same across the channel in Europe as well, whether it's UniCredit looking to buy a Commerzbank or others, Monte dei Paschi looking at Mediobanca, or even my old shop, BBVA, looking to pick up Sabadell. You're seeing that local consolidation in order to grow market share, develop scale, be able to use that kind of additional income that's come in from the elevated interest environment in order to scale, grow, and invest. And it makes sense. When you look at the world around you, there comes a point where in order to be off scale sufficiently to grow globally or defend your niche, you need a balance sheet of a particular size. And we're seeing that across Europe as well. And we've seen some of that already last year here in the UK. There just comes a point where investing in talent, giving the technology that you need to be able to do that, the cost that's involved with that, you need a certain scale. There are limited numbers of targets to be able to do that. I suspect we'll see a little bit more of it as the next 12 to 18 months play out as well. We're very much not done in that space.
I think the UniCredit deal with Commerzbank and then BBVA with Sabadell and UniCredit, all those deals make sense from a consolidation perspective. I think the parallel to the US around the regulatory environment is quite different. And not just the market fragmentation, I think the regulatory environment in Europe, I'm curious to hear if you have more insight or certainty, but I understand that at least the BBVA and Sabadell and UniCredit are opposed by governments. And then with the fragmentation of the different countries, it's become a bit more tricky. So it'll be interesting to see how the consolidation pans out in Europe relative to the US under Trump.
On the BBVA Sabadell one, it's quite interesting. Sabadell are moving their headquarters from Alicante to Barcelona. I mean, that's quite a defensive move given, the regional makeup of the country. And we'll see how that one plays out. I mean, BBVA, the last I saw, feel quite confident that they'll be able to pull that off. It's been talked about for quite some time. But it's a prerequisite, I think. Those countries can only support so many large players. And, in Spain, whether it's Spain, Germany, or Italy, there is a finite number of large banks that you can have. We'll see whether the regulators step in to stop that or not, or whether they get, they're able to change government's mind. But when preserving national identity, economic strength, you want strong players. And I think as the last, 96 hours have shown in the banking space, that is something where you probably want that size in order to have that stability.
It seems like the sort of landscape has changed a lot, and that, a lot of the reason that so many deals just slowed down, right, is rates came up and a lot of balance sheets were just underwater. I do think there's a lot of disillusionment on both sides in terms of recognizing, well, really, what is the value of consolidation, right? The reality is, historically, it was easy to say, hey, we're going to just cut costs, we'll get rid of some shared corporate overhead, and then we've just got a bigger balance sheet. But the reality is, a lot of these balance sheets are not structurally that profitable, and the ability to look out into the future and say, how are you going to continue to grow, has really changed, just because the drivers of that are no longer physical distribution, it's much more technical distribution. And so I think the combinations are going to start to become a lot more creative. It might not be as obvious as this size. It's going to be many more strategic acquisitions that might be putting together a number of different components before we really start to see what that vision is for successful FIs.
Yeah, and I mean, that touches a little bit on the why do people do this? And I know that is that's such a multifaceted 12 hours of conversation later, we could still be talking about that one in terms of why people do it. But has that sort of evolved a little bit? Because, I mean, again, big bank by medium-sized bank, okay, you're doing it for scale of customers and the book that they've got and all these different things. But, BBVA has been talked about a lot already in this, and they were one of the earliest ones who were picking off technology-enabled businesses to sort of evolve their culture as much as anything else that was happening there. So, what's the real main drivers? And actually, I mean, I don't think it's as easy as is this strategic? Is it for technology? Is it the truth is probably somewhere in the middle of all of these things. But I mean, Josh, again, having lived through these things and no doubt pursuing many of these things now, what is it that you're looking for, the value add here in that type of relationship?
Yeah, well, I think to your point, originally you could say, well, let's buy this book, and we know this book is a book of loans that's gonna, has a positive yield. But the reality is, the biggest on the U.S. side, the biggest quote acquisitions in the last 2 years were bank failures because they had assets that were not earning a market rate. They could not cover their cost of capital. And while those were extreme examples, the reality is a lot of the industry still has an asset base that's priced on, interest rates of 2 years ago. So it's not obvious, the marks that you have to take to come in and to purchase one of those banks right now is a huge, is a huge step up front. But even beyond that, it says, do these banks have the ability to go out and acquire new loans that are going to cover their costs? And even if they do either they or you and your existing bank have the deposit base that you can protect and feel confident about, given that there is so much additional competition from whether it's fintechs or the very largest banks that we continue to see consolidate the deposit base, that's a very different question. So I think now the thoughts around acquisition really has to be much more strategic to say it doesn't, each or any given acquisition doesn't have to solve all of those problems, but you need to have a solution for each of those problems as you put together that portfolio of the businesses that are in your existing business and anything that you look to acquire.
Yeah, there's an interesting thing there around actually how similar is the business to ours, and therefore, mixing, salt water and fresh water together, is the culture going to sustain it? And a little bit back to some of the points that was being made in the studio as well, is like actually, but really, not wanting to pick on BBVA as an example, and I appreciate it's your old gaff as well in terms of talking shop there, Nick, but they didn't do a great job with some of those things. I know we can put it off with learning, with Simple or Bank Simple and different things that are there, or Holvi and the investment, but I think banks are maybe a lot better at doing that now because they're a bit more mature about what it is that makes them successful. Josh, to your point, a big spreadsheet with all the customers in it doesn't mean you can take that customer base forward and deliver something beneficial to them. But understanding what makes that business tick, Nick, the stuff that you're acquiring to make it work, that feels like a big part of this process now as well, right?
Yeah, for sure. I mean, I think, what was clear with the acquisition by HSBC of Silicon Valley Bank UK is they really understood the special source of the business that they were buying, how delicate that was, and what was important to sustain that business and its role within the ecosystem. And they've done a great job at that, I think. So that's critical, absolutely critical to that kind of evolution and delivery of a decent acquisition outcome. I mean, I was thinking when I was listening to the other panelists talk about this, I think it's not only that you need to make an acquisition in order to solve some of those problems that banks are facing now. You don't need to buy a fintech or another bank. You have other options now, whether it's you can invest in them, you can partner with them as well. Most large banks have their own VC investment arms as well, where earlier on you can start to dabble in those spaces where you think you might have challenges in the future in order to learn, but also to see some potential upside there as well. So I think, the playing field has changed in the types of options that are available for you as a large bank in order to think about how best to solve those problems, because the acquisition of itself might always, as you were saying, could only be part of solving for that problem. It's one solution now, and there are many others that you can think about.
Yeah, I completely agree with that. When I said maturity earlier on, I wasn't calling everybody a big baby, by the way, just so everybody listening to well, I meant exactly like that. It's the maturity of actually how you develop great products and great services. It's a different tapestry that we're playing with now. How many organizations have I worked with in the last 20 odd years where it was like, that's great, but we'll build that internally. Like the opening up of the technology approach to partnering or bringing in or investing and use it, like it's a very different world we live in, and that for everybody I think is a great opportunity, because you're right, you don't have to acquire a business to be able to play really nicely with it. But equally, that is an option in that front as well. We're going to talk about this a little bit more and get the sort of crystal ball out of where we see this going from an industry perspective very, very shortly, because these things are getting bigger. The acquisitions are getting bigger, the pace of them are getting bigger. But as those consolidations increases, the competition for these things intensify as well. So, the suitors for these types of things are really interesting as well. So we're going to take a quick break and be back with you shortly, but it'll be crystal ball time.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alicabank who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
Average is not invited. Not if you're holding your company off-site in Las Vegas. We aren't on friendly terms with the bare minimum, and unenthusiastic is uninvited. Las Vegas's creative energy and world-class hospitality want to bring your company off-site to crazy new heights. That's why fear-based leadership is afraid of Vegas, and boring won't be there, but it will be watching the meeting recordings later. Plan for the extraordinary at vegasmeansbusiness.com.
Hey folks, welcome back to the show. Earlier in the show, we were exploring the forces driving mergers and acquisitions in the finance industry. Now what we're going to be doing is turning our attention, though, to what lies ahead. Who might be on the top, and actually who might be a opportunity for a merger and acquisition in this regard. I realised that who might be on top was actually a real sort of lewd comment there. Well done, producers, on that one for making me say it. All right. Earlier in the episode, we discussed what mid-sized banking options might be in the UK and seeing that sort of consolidation. But I guess we've got quite an established fintech scene in the retail space. I mean, Jamie, do you think we're going to see mergers and acquisitions in that space, or is it likely the banks that are growing in that space are going to start to do them? Obviously, we saw somebody like Starling acquiring a mortgage book, didn't we? Do you think we're going to see more of the bigger the fintechs get, the more of a threat they become as well?
I think Josh hit on a good point earlier in the podcast, which was, more creative looks at these acquisitions. So the one type which is around the shoring up of the balance sheet, battle testing for more stability and kind of everything that these large organizations need to defend against. I think yes, there'll be acquisitions like that. But I think looking more into some of these creative areas where I was reminded as people were talking of the acquisition of Atlantic Money by Deal, a global payrolls business which is helping source global teams, acquiring a Swift competitor to make that kind of part of their infrastructure work smarter and work harder. And I think taking an acquisitions approach to how can we go deeper on services to make our clients' lives easier, as a kind of a complementary category alongside the more traditional banking style acquisitions of let's buy a suite of books, or let's buy a bunch of assets which are just going to shore up our balance sheets. So I think Josh is right. I think we will see a lot more of those types of creatively driven approaches to acquisitions when it comes to fintech involvement in acquiring other businesses.
And you, I mean, that points to something you sort of mentioned earlier on, Mariela, as well, in terms of, I mean, this isn't just financial services organizations acquiring financial services organizations, right? You touched on Amazon. Amazon have got they've got all of the money, haven't they? If they wanted to go and buy anything, they can go buy anything, let alone financial services. I'm pretty sure they've got half of the moon already sort of on layaway, So what do you reckon? Do you think we'll see more of that as everybody wants to get into financial services because of expanding out their revenue opportunities or being able to gain access to that type of base? Is it inevitable we're going to see more people getting into the financial services space through acquisition?
I think there's going to be a few waves of drivers of M&A. There is indeed around the technology space, in investments, the big tech stands to win because of the AI infrastructure, but also around the data centers. And access to those data centers becomes critical as particularly the larger banks are embedding more of their AI capability more broadly across all their operations front to back. The other key part is, let's not forget the sponsor deals and the VC-backed deals. There's questions around a few of them, of course, exiting through IPOs. We've seen Klarna, we've seen Stripe and Chime, but quite a few companies are either going to take the hit the bullet in terms of the valuation, and others are being forced into the sort of marriages around M&A, which is also not ideal. So I think that's coming as well. And then the other key part is I do believe consolidation in the US has been hampered in the previous years around the direction of rates and regulatory environment. And now I think with the current administration and also rates tampering, we're going to see some significance around the consolidation. I think banks are emboldened. Since the election, a lot of the valuations of regional and community banks increased. And after the Old National Bancorp transaction last year, we've seen the share price increase, which is also driving more confidence around some banks looking at their pipelines now and starting to increase their lookout for deals. And as Josh mentioned, I think deposits and location around where the high quality deposits is going to become critical. The yield curve turning positive as well is going to help with bringing the funding costs down and the potential for margin expansion. So that's contributing as well. But you're right, on the big tech, it's Amazon. I think Microsoft is very well positioned. I know a lot of banks are working with Microsoft either on the AI or in the tech space. Amazon, particularly around the databases, and when it comes to embedding some of these technologies around agents, around AI, it's a bit more tricky to work with. Some of the fintechs, the larger players already embedded in terms of those relationships, and they're stand to win in those transactions, which are not necessarily M&A. These are partnerships.
Well, that's the thing is, and it becomes an interesting, I was referring to that tapestry earlier on of, different, I just think even if I'm sitting in the regulator, Jamie, right now and going, if I want to get in touch with the CEO of HSBC, they pick up the phone to me. Mark Zuckerberg, don't give a shit. Yeah, ain't going to pick up my phone, So is that an interesting problem in this space to a certain degree? If more of the big tech do get into it through M&A, then actually those frameworks of control start to get quite blurred as well.
Yeah, and I think the if I was a regulator now, I would be trying as best as I could to start building those relationships within the big tech organizations and trying to scope, how and when. Because I think it is a matter of when. I mean, we saw X, was it last week? Start making a move into account-to-account payments in the US. So I think it is a when. I mean, WhatsApp has been moving money around in India for years now. It's a case of when these firms are going to get into financial services and how I can, how as me as a regulator can go in and start to understand and build those relationships so that we can kind of keep some semblance of control and oversight on these firms, because it's just going to get more and more complex. And I think the FCA has done a good job in starting to become more collaborative with innovators, Project Innovate, Sandbox, all that kind of stuff, really good stuff. But they need to have a defense against big tech coming in. It's not going to be a Project Sandbox environment. That's probably quite certain. But what's it going to be in place of that, and how do they get a grip?
Yeah. So, Josh, just sort of bringing you on that, what do you think the nature of the regulator sort of has to change with this regard as well, isn't it? No longer is it, FS to FS and everybody's regulated, therefore everybody, needs to be playing by the same rule book. But obviously everybody needs to be playing by the same rule book. Don't get me wrong, I'm not advocating all out craziness or anything, but the nature of the regulation changes based on the actor in which you're dealing with, doesn't it?
Sure. And I think, Yeah, there's no question. The landscape is getting increasingly complex, right? There are a lot of different players in it. I think in terms of big tech, there's no question they're going to continue to get closer to and more supportive of and pick off pieces of financial services, payments being a great example of it. But I think we have to remember financial services is capital intensive. Tech companies don't like that, right? They get much higher valuations on their low capital businesses. So one, that's not very attractive to them. Two, at least in the US, small and regional banks are responsible for the majority of small business lending, the majority of commercial real estate lending, the majority of agricultural lending, a lot of housing lending and finance. So there still is a need for the economy, not to mention our communities and our families and lives, to have these financial institutions that can support those markets that haven't necessarily been well served by fintech solutions because it's just hard to put all that into an app. So I think there's going to require this sort of, I guess, your tapestry, right? It really has these different elements of it, and there's no question that that the environment is rapidly changing. I think for sure we expect that the regulatory framework is going to be more conducive to mergers and acquisitions. Obviously, some of that just comes down to just literally the amount of time that it takes to get to get deals reviewed or done, and whether that's a fast no or a quick no, it at least takes some of the risk out of trying to put those deals together, right? And in a similar way that it was talked about before, that Nick was saying how you can essentially de-risk some of these transactions by investing first or partnering first. The fact that there's going to be a more clear regulatory framework also helps with that. But yeah, there's still a lot to change. I'm rarely the first person to mention it, but I think crypto, since no one has yet, I think that's clearly going to come roaring back in terms of what it does. I honestly don't see it displacing a lot of the more fundamental things that happen in the financial markets for a whole lot of reasons, at least for some time. But there's no question that's going to start to get a lot of attention now. And of course, AI is really changing just some of the basic economics of, how certain systems work and how we can reduce costs, how we can build efficiencies. A lot of those are where, those are the types of things that allow FIs to change how they compete, whether it's through combination or otherwise, and essentially level up.
Yeah. Just sticking with that point, because I think it's a really it's always sort of like exciting to talk about these things in the moment, but the reality is like everything is a cycle, and actually, back to the point you just made, and I forget the exact wording that you said it, but the banking's capital intensive. Banking is a really capital intensive thing, but also banking generally works best if you've got something as a conduit in the middle. So, being in a situation where you offer many products to a single customer versus just a slice of a single product that you own to a single customer. And actually the sort of flurry, it's good. I know there's people listening to this going, you're describing universal banking. How dare you? But it's like, yeah, it worked really well. Like, so actually, are we just at a point in the cycle where a bunch of fintechs and a bunch of organizations, it's the old, is it a product, is it a business or not? And actually there's a lot of things in the market that are products that are being now acquired by more mature businesses, because actually they can bring the scale to those things to make them, less risky, that are higher value, to introduce them to their broader book. It just, when you were saying it, and I don't know if it was your accent, Josh, or not, I was just like, yeah, that all makes total sense. Like we should just end it there.
Well, you make many two ways, right? Unbundling or bundling, isn't that so I think the reality is we can see some very, very successful monoline businesses, the handful of neobanks that have really taken off. And really, if you think of Chime, they've done an amazing job and they have a pretty narrow product set by design. It's not a criticism. It's actually probably the highest compliment that they've had that focus. And same thing with SoFi and Lending Club. I think, and this is where as these deals start to come together, whether it's bank to bank, bank to fintech, fintech to bank, I think there's going to be more realism now, as informed by recognizing that there's still no magic wands here, right? And I think at the outset, it was like, hey, are you staying close to your customer? Do you really understand them? Do you understand risk? And even if it's a lessened regulatory environment, the reality is taking too much risk or harming consumers is not good. It's not stable in the long run. It's bad for investors, bad for community, economy, et cetera. So I do still think there's more realism this time around. So I think people will just be more thoughtful about, okay, when does it make sense to either do a lot of products or do one product?
Yeah, just to the House Financial Services Committee recently did announce measures that reduce the threshold for community bank mergers, and they're evaluating the bank deals. So the expectation is the majority of the consolidation will happen, but it will be, to your point of scale, David, it will probably for banks under 100 billion balances, because these thresholds in the U.S. are super important. And there's a cautionary tale from I think it's the bank Flagstar, who ate more than he could swallow. I don't know if you guys remember that story, but it started taking a lot of acquisitions during a short period of time, which, as just mentioned before, this happens still quite a lot in the US. And it pushed the balance sheet up to 100 billion, which means stricter capital rules. And it was unprepared, I think, on its real estate book. And it ended up with losses around 71%, sorry, within year to date, which was crazy. So there are real disincentives when it comes to the size of the balance sheet in the US. And this is why, banks are cautious in terms of how much they can build up in terms of acquisitions and where does it not make sense from a capital perspective.
Yeah. Yeah. And ultimately, consolidation in that sense and less FIs out there supporting customers, is that a good thing or a bad thing as well, right? Because there's all of the FCA in the UK and the competition mandate and increasing the pressure on big organizations to, step in line with the world that's changed. There's different measures for these things. And it does feel actually at the different points where the markets are, then different regulatory pressure is required or different regulatory support is required to do the thing that it wants you to do at that point. But I think we've sort of talked ourselves in sort of circles. I think we've talked for the positive of M&As being this is the sort of cleansing of the industry and the growth of the industry, and this is the way it's been done. And we've sort of mentioned all of the sort of trials and trepidations of doing it. So, but maybe I guess Jamie, M&A is like a good thing.
Yeah, I mean, absolutely. How else are some fintech businesses going to find their exit? Yeah, and I think we're in an interesting time of M&A. I think I'm interested to hear what people's thoughts are, about the future. New president, interest rates, tariff war, maybe. All of these kind of macroeconomic factors that are kind of pushing and pulling the industry and having an effect. I mean, I'm sure everyone here has got a pretty insightful view on those things.
Yeah, I can't help but feel most of those things sound like subheadings to Star Wars movies that should be out there. I'm pretty sure the whole tariff war thing was like the first remake film, wasn't it? But Josh, what do you think? Is this all pointing to a more fruitful environment for M&As or less?
Well, I mean, you just referenced a whole handful of things that introduce a lot of uncertainty, right? Overall, the reality is, at least we know that scale is rewarded in financial services because it's capital intensive, as already talked about. We know that there are challenges for FIs to obtain the technology to compete, the talent to compete, and ultimately, as a result of that, to hold on to deposits, which really are the sort of inventory that makes makes their business run. So given all of that, I think really what the M&A market, it's giving an opportunity for banks to now think about how they go buy instead of build. You have banks that have strong connections to their communities, to their customers, but they lack some of those other elements. Larger FIs that have some of those other elements and take a thoughtful approach to how they can strategically integrate those smaller institutions are going to have an opportunity to both scale in that regard. And I think you'll see FIs going out and being very strategic about both banks and fintechs that they buy that can help accelerate them down the technology path in particular. So they can go back to solving that issue of how do you generate loans that can cover your cost of capital? How do you hang on deposits? So I think we'll just continue to see increased velocity as things open up here, despite other uncertainties in the world.
Yeah, I agree. Nick, what do you think? Is the current environment fruitful for this type of thing getting more frequent, or where in the cycle do you think we are?
I can talk from, the conversations we're having with clients and then thinking about what the next 12 months look like and some of the acquisition situations that we've been involved with them, either as an advisor or scoping out opportunity or thinking about how we can support that with the financing. And the one thing, well, there are many things that they'll look for, but really what you need is predictability and a degree of certainty in order for you to be able to plan. You want to know, have some sense of what the regulatory environment is going to look like. You want to have a sense of that you can actually deliver value through the acquisition and you can integrate it successfully. And you want to know that however you choose to finance it, the cost won't go up. It will at least be manageable in one way or another. Bunch of factors that you look to. I would say we've been more active in initial conversations or closing deals or talking through prospects in the last quarter than in the previous year and a half that I was at the bank. But we're not talking about bank-to-bank mergers. I'm talking about fintech consolidation, where it's, buying a new license that maybe a fintech didn't quite make it. It's looking to expand into a new geo. It's considering buying another kind of book or a distribution channel or access to a customer base or expertise that previously might not have been available to you. Because what has evolved is, people's expectation, that bid-ask spread that exists between the two, have started to consolidate a bit. And when you have certainty and predictability in markets, then people can take a view on what the future looks like, and you can lean into that and plan. So I think that's absolutely key for the environment. So when I look forward, the expectation is, more broadly, as Mariela was saying, interest rates are expected to trend down, and that will give a little bit more certainty to valuations. Take a cue from public markets in order to drive valuations more broadly. We're also seeing an evolution of vintages of founders. We're now people who are at that 5-7 year stage who are thinking, well, it would be great to be thinking about doing something else. Is this something that I want to devote another 2 to 3 years to? And then as Mariela also said, and I think we've not really touched on, but is absolutely key, that absolute wall of money out there that exists in private equity, which is around 2.5 trillion of unutilized dry powder, provides an opportunity for meaningful consolidation within the broader fintech environment, not necessarily just banking, but within payments as well, whether it's public being taken private, turned around, or putting business together and creating a greater whole. That money needs to go somewhere. So there's a lot of drivers right now, which on paper suggest this could be a really golden year of M&A activity. Last year was up on the year before, So if you take a step back and say, well, there's no more elections expected. We, in theory, should have some political certainty or predictability. We've got an interest rate environment which should trend in the right direction, assuming inflation stays under control, and a wall of money to support that, plus vintages that people want to exit into, plus more thoughtful banks about how they go about acquisitions. And, that role that strategics can play. And it's not just, the Visas and MasterCards of this world, but it's the PayPals, the Adyen's, others who might look to add to that. It really should, in theory, on paper, be an absolutely phenomenal year if you're a founder looking to exit. We need to see what the next 30, 40 days are like and what certainty comes out of that. But if we get through that, I really think it could be a great year. It really should be a great year for people to find ways to kind of recycle capital and people and ideas and talent, which is super exciting for the fintech space.
I love that. I love that narrative of vintages of founders. That sounds great. I mean, I just thought I was getting old. I didn't realize I was a great vintage, but made me sound like a fine wine. Like, I love that. That's great.
There's a combination of lots of great words, but also, Nick, that your voice is built for radio. I'm sat next to you, and I'm just like, I feel like I've got some sort of audiobook going on.
There's a presence. There's a presence.
Yeah, there's a really nice presence. Yeah, exactly.
Guided meditations.
Exactly. Yeah, I'm sure your team are going to listen to this and probably think the same thing.
Yeah. I guess with just to sort of summarize everything everybody said, I guess with any market, we're in a place where, it's either a seller's market or a buyer's market, isn't it? And actually, I'd say for all of the market conditions that we've seen, it is a buyer's market right now. And actually, the opportunities out there with funding becoming more difficult or regulations making it more easy or, availability of capital within organizations to make these things happen, it feels like actually exactly as you say, Nick, that, we're going to see some organizations going on a bit of a sort of spending spree to make this happen. So I reckon we're going to come back to this topic a lot because it will definitely be something we'll be covering in the news a lot, that such and such buys whatever. And, it will become much more of a frequent staple. Whereas, back in 2016, 2015, it was new businesses being created. I think the acquisition of businesses in this period are going to really pick up the pace. So on that note, though, and I think we probably could talk for several more hours on this topic, but we'll do it in the news as we go and get you all back to talk about it. We're going to end the show here. So thank you very much for the panel for joining us. Where can people learn a little bit more about you and all the good stuff you do? Mariela, starting with you.
Yes, please connect with me on LinkedIn. And if you're still implementing how to embed AI and AI agents into your tech stack, financial services, or beyond, connect with me. In fact, today I'm publishing an article on AI agents in banking, which includes use cases and some of the cool companies that are popping up. You might want to check those out. And if you are looking to unlock your full brain's potential, neuroscience, and AI precision, join Synaptic AI today. The beta is filling up fast, so you don't want to miss out. That's Synaptic with this SYNAPTIC.ai.
Very cool. Thank you very much. Josh, where can people learn a little bit more?
Yeah, sure. LinkedIn, whether it's talking about embedded banking with Seattle Bank or CD Valet, our digital deposit marketplace serving community and regional banks, it's competing digitally.
Very good. Jamie, where can people learn a little bit more about all the stuff that you're up to?
Yeah, LinkedIn, Jamie Campbell, 11FS.
Very good. Nick, where can people learn a little bit more?
Like everybody else, I'm on LinkedIn, just Nick Conway. But reach out to me. I'll do my very best to reply if you send me a contact request or fancy meeting up for a coffee. I'm always loving to hear what people are building in the fintech space, so that's always very cool.
Very cool. As for me, do you know what? Give me a ring on the phone. You can get me on 077. No, I'm joking. I'm not going to do that. Find me on LinkedIn. That'll be good fun. Thank you so much for listening, everybody. If you do like what you heard, follow the podcast and don't forget to leave us a review. It helps us make the show better and helps other people find the show as well. If you do want to get involved in the conversation, you can find us on pretty much every social media channel or just search for Fintech Insider. Or if you want to, email us on podcasts@11fs.com. Thank you very much for listening, everybody. Goodbye.
Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks, like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.